All right, guys, quick video today. We're talking about income taxes, and they've really scaled back how much they want us to cover in this class when it comes to taxes for a lot of reasons. One is you're taking a college class. You're taking a class here at the high school that's going to cover this in a lot more detail anyway. Also, a lot of this is out of your hands because most people don't do their own taxes, and this is all information that's good to know, but it's a lot of it's stuff that you're not ever going to have to actually deal with yourself. You're going to have somebody that kind of runs all these numbers and takes care of what's best for you anyway. But just so you have a brief overview, what we're talking about, the money that you make gets taxed. And that money is used, depending on where it goes to the state or the government, it's used for an endless variety of things, from money that goes towards schools to keep programs funded, like parks, like the city, like the police and the fire departments. It goes towards government agencies. It goes towards things like Medicare and all these other programs out there that keep our government running and keep our roads paved and lights on the streets and all these different things. Now, what you need to worry about is how much income tax you're going to have to pay. And what happens is when you get a job, you fill out a form and you tell them, this is who I'm responsible for. And based on who you're responsible for, they'll decide how much money they should keep in taxes. Okay. So your gross income, this is all of your income that you make in a year. So all of these are yearly amounts. Now, this is money that you make from your regular job. This can be interest that you earn on a savings account. Any income at all goes towards your gross income for that year. So then you minus adjustments to income. So some programs, like if you put money in an IRA or a retirement fund, they don't tax that money when you put it in. So if this is how much you make, but you put some of it into a retirement fund, you don't have to pay taxes on that. That's what adjustments are. When you're done with those adjustments, when you take away that money that you've invested or done other things with, you end up with an adjusted gross income. Okay. So this flow chart just kind of shows you where things go. So your adjusted gross income is where most of you are going to start. At this point in your life, not very many of you are going to have adjustments to your income, but some of you are going to have things called deductions and exemptions that can reduce the amount of money that you have to pay taxes on. And that's kind of the goal. We're trying to get the amount of money that we have to pay taxes on lower and lower so that we don't have as much money going out. We get to keep more of it for ourselves. So exemptions are things like if you are responsible for a child or a parent. Okay, maybe you are working and paying to support a parent, or maybe you are working and paying to support a child in your home. There is a set amount of money that you don't get taxed on. You get exempt from for that. You even get exempt from yourself. I think last time I checked, it was around $4,000 comes out of your income amount that you don't have to pay taxes on, just for you. Okay. Deductions are things like mortgage interest. Not your whole mortgage payment, but your mortgage interest comes from deductions. School expenses come from deductions. So money that you have to pay to go to school. Business expenses, if you have a business, a lot of that can get deducted from the amount of money that you earn. Childcare, like if you're having to pay a babysitter, that can come out of your income. All of those are deductions. There's also a standard, kind of a set deduction that can come out as well. The point is, all of these come out of what the government considers money that you make. And they say, okay, so after you make all your money and you put money into retirement and you have all of these people you're responsible for, and so they have expenses, what's left over is the taxable income. So taxable income is what they're going to take a percent of for taxes. So all of this amount that you deducted and got rid of is money that you don't have to pay a percent of towards taxes. All that you have to pay on is that taxable income. And from there, that taxable income up here is based on how much you make. The more money you make, the higher percent you're going to have to pay. And I'll show you that table here in just a little bit. But even from there, you minus some tax credits. So at this point, this is the percent you have to pay. And there's some things that you can minus credit for, like there's a child tax credit for each child that you take care of. I think it's usually about $1,000. They'll say, okay, you owe $12,000 in taxes, but we're going to take $1,000 out of that. And what you end up with is your total tax, what you have to pay throughout the year. Now, you've been paying that every month when you get a paycheck or every paycheck from your boss. They take money out of your paycheck to pay towards that amount already. And a lot of times, if you have paid enough money from your paychecks every month, at the end of the year, they might actually owe you money. So at the end of the year, if you've paid more than what you owe, you get a refund. But let's say you haven't given them enough money based on all these factors going into it. You might owe some money at the end of the year, extra from what you've already paid. At your age, this doesn't really happen. As long as your work has been taking out the taxes that you told them to on that form when you signed up with them, you shouldn't owe. That's really not something you run into at your age. That's something that you're going to run into as you get older, as you start to make more money and have more people that you're responsible for. That might change, okay? And usually it's because of something you did, and we'll talk about that more in class. But usually if you owe money, it's because you did something during the year to make that happen. And we'll kind of talk about how to avoid that in class. So this quick video that's now rambling on, income tax forms. So just Karen's earning $38,600. That's what she gets from her job, and she receives $750 in interest. So if you take that $38,600 and you add the $750, that is going to give you her adjusted. That's going to give you her gross income because we haven't taken anything out yet. So this becomes $39,350. So that is her gross income. All right. And she contributed $1,200 to a tax deferred retirement plan. So here's where you get to minus the $1,200 because she put that into a retirement fund. So you're left with $38,150. Now that's your adjusted amount. Because you took out the IRA, that's her adjusted gross income. So we've got her gross, and now we have her adjusted gross income. Then it says she's entitled to a personal exemption of $4,050 and has deductions that total $6,350. So I get to minus another $4,050, and I get to minus her deductions, the $6,350, to find her taxable income. So here's her gross. Here's her adjusted gross. So now let's take that 38150 and let's minus 4,050 and let's minus the 6,350. And I end up with 27,750. So that is her taxable income. So what that means is she only has to pay a percent of this amount. She doesn't have to pay a percent of the $39,000 that she made. She only has to pay a percent of this $27,000. And here's where taxes get interesting because everyone's goal is to make that amount, that taxable income, they want it as small as possible. Great big companies make giant donations at the end of the year to make this amount go smaller so that they don't have to pay as much in taxes. All right. So filing status. Again, we're going to go through this kind of fast, hopefully faster than I've been so far. The amount of tax you pay also depends on your filing status. So you can either file as single, meaning you are only responsible for you. You can file saying that you're married and you're going to file jointly. So you're going to file together, meaning you're going to combine all of your money and you're going to combine all of your expenses. Or you can file and say that you're married, but you're going to file separately. Separately, whatever that word is, meaning that you are married, but you are going to keep your income and expenses separate. Sometimes that's beneficial. A lot of times when you're dealing with families that have a divorce or mixed families, sometimes that option works better. But usually the joint is a better option. And we'll see some examples another day. And the fourth option is called head of household. And this is kind of you aren't married, but you maybe have kids that you are responsible for, or maybe you have parents that live with you that you are taking care of and you're responsible for. So you will choose one of those four statuses. And based on that status, you get an exemption. So for example, in 2017, the fixed amount was $4,050 that a single person was exempt from. But a married person might be exempt for more or less than that amount. And depending on how many kids you have, you're also you have exempt amounts for them as well. Okay. So exemptions are kind of fixed amounts, and it varies. Every year it changes a little bit, but you are exempt for basically anyone you're responsible for. Okay. Anyone that you are responsible for, including yourself, counts as an exemption. And if you think about it, if you have 2 or 3 family members and you're each $4,000 exempt for $4,000, that adds up pretty quick. That can be a large amount of money that you are exempt from having to pay because you have to buy them food, you have to pay for their clothes and different things like that. Deductions vary from everybody. The most common, it has a few listed here: interest on mortgages, money that you contribute, so donations that you make, taxes that you've paid for other reasons. All of those are deductions. And at the end of the year, you get to decide. You can either use what is called an itemized deduction, which means this is usually for people that have a lot of deductions, like a mortgage. They might have a lot of other expenses that are tax deductible. A lot of business owners do their taxes this way with itemized deductions. But at the end of the day, it's only about a third of people total itemize their deductions. Most people just take what's called a standard deduction, because a standard deduction basically says, based on your income, you get a standard deduction of $6,000. For a lot of people, that deduction amount out of your taxes is more than if you added all of this stuff together, especially if you only rent. You don't have mortgage interest that you're paying. If you don't have a business, you don't have any business expenses. So 2/3 of people choose to go with just the standard deduction. Okay, so here's an example. Suppose you have the following deductible expenses. So you pay $4,500 in interest on your home. So you've got $4,500 in interest. You pay $900 to charities, and you pay $250 for state income taxes. So that means that if you were to itemize all of these deductions and you would add those together, so I would take $4,500, add the $900, add the $250, and that means I could itemize and say, hey, that's $5,650 I want to be deducted. Okay? Or you're entitled to a standard deduction of $6,350. You do not get to choose both. Okay? You have to choose either this amount or this amount. You have to choose. And that all is based, again, it's situational. Everyone's situation is different. If you've bought a home recently, your interest is going to be a lot higher than someone that's been paying on a mortgage for 25 years. So this might add up to more than just the standard deduction. But again, a third of people use the itemized, but 2/3 are just going with the standard. Whether it's because they don't want to try and find all the deductions and they're just lazy and they would rather just take this amount and not have to think about it, because everyone's going to get that amount. Or they want to put in some effort to try and reduce the amount they have to pay on. All right. Okay, moving on. Tax rates. I just wanted you to see this really quick. You can pause and look through it. But this is basically saying that the tax rate, you're going to pay 10% taxes if you are single up to $9,325. So if you make $9,325 or less, then you are going to pay 10%. That's your tax rate. But if you're married and you're filing with your spouse, you can make up to $18,000 and only pay 10%. If you're the head of household, you can make up to $13,000 and still qualify at 10%. Okay. And then, so as you go down, if you're making $418,000 and you're all by yourself, you're going to pay 35% in taxes. If you're filing with a spouse, you could make up to $470,000 and still be in this category. So the more people you're responsible for, the higher this gets. Okay. Standard deduction basically is based on where you file. If you file as single, your standard deduction, it doesn't matter how much money you make, your standard deduction is $6,000. So for people that make smaller amounts of money, that standard deduction, look at that, a standard deduction of $6,000. If you only make $9,000, that only leaves you $3,000 that you have to pay taxes on. But for someone down here, for someone making $418,000, that $6,000 doesn't help them very much. That doesn't reduce their taxable income very far. So the people that itemize their deductions are usually the groups that make a higher amount of money. They might have reason to, they might have more to deduct because they have more money to spend and use and do things with. But they're usually the ones that do the itemized, them and the business owners. Exemptions. So what that means is, again, every person you're responsible for, you get to take responsible for. So for every person you're responsible for, you don't just get this standard deduction. You get to take another $4,000 off per person. So for me, I have my spouse, and we have 6 kids together. So I get to deduct, I'm exempt. I get to times that by 8 because I'm responsible for 8 people, which that's a huge deduction or a huge exemption. That's a large, when you have a big family, you have a lot of expenses and they know that. And so you get a lot more tax exemption. So basically that's like $32,000 in exemption. So that's $32,000 you would get to take off your taxable income that you wouldn't have to pay taxes on because you're too busy buying $30,000 worth of food in a year. 8 people eat a lot of food. It's crazy. You can pause this, look over it a little bit more if you want, but that's kind of how the bracket works. Example 5, we'll try and wrap things up here for you. Renting or owning. Suppose you're in the 28% tax bracket and you itemize your deductions. So that means you are not going to take this standard deduction right here. You are going to itemize. You're going to itemize all of your deductions. And you're trying to decide whether to rent or buy a house. To rent, it says you'll pay $1,400 a month if you want to rent. You've looked at your options. If you were to get a loan for a mortgage, you would pay $1,600 every month on that mortgage. But then it says an average of $1,250 goes towards interest. So $1,250 of that goes towards interest, which is a tax deduction. based on your tax rate. So it wants to know which one of these is actually cheaper. Would it be less expensive, even though you pay $1,600 a month? Because of the tax deductions, would that be cheaper than renting? So what you have to do is that $1,250 in interest, you don't get to deduct the entire amount. You only get to deduct your tax rate percent. So you have to take that $1,250 and times that by your tax rate, 28%. So if I take $1,250 and I times that by 0.28, that means that I can take that's $350 that I can deduct from what I pay every month. Well, that $1,600 a month just got reduced by $350. So now I only pay $1,150. Nope. $1,250 a month. I still have to pay the $1,600, but at the end of the year when I do my taxes, it's kind of like you get $350 of that back. Okay, so I'm only paying $1,250 dollars every month is my true cost. Okay, so you pay the $1,600 a month, but when you file your taxes, it's as if you only had to pay $1,250 a month. So when you look at the difference, there's a lot of things that go into that. That is cheaper every month in the long run, but kind of like mortgages we talked about last time. What if you can't afford $1,600 a month? It doesn't matter at the end of the year if you get this money back. If you can't afford that every month, then this is your better option. But true cost in the big picture, if you could afford it, this would be your better option because you're going to, in the long run, you're technically paying less every month. All right. All right. So now values of deductions. And this, I think, I almost skipped over this one, but I think it's kind of cool for you to see the true cost of these deductions based on your percent tax rate. So Drew is in the 15% tax bracket. Marion is in the 35% tax bracket. They both itemize their deductions and they donate $5,000 to charity. So let's compare their true cost for the charitable donations. So what that means is when Drew donates $5,000, 15% of that he gets to deduct from his taxes. So he gets to take 15% of that out of what he owes in taxes. But when Marion does the same thing, when she donates $5,000, because she's in the higher tax bracket, she gets to take 35% of that $5,000 out of what she owes in taxes. So for Drew, his $5,000 saves him $750. So basically, that's like saying he gets $750 back in the tax bubble. Okay, he doesn't actually get a check for $750, but he gets $750 back in tax deductions. So what that means is the true cost for his donation, because it saved him 15%, really he only donated $4,250. Physically, he donated $5,000, but the true cost was only $4,250. Well, look at what happens to Marion. When she donates, is Marion a girl name or a boy name? I have no idea. I keep hearing Miriam in my head, but that's not Miriam, it's Marion. Anyway, $5,000, Marion gets to deduct 35%. So that means that Marion is getting $1,750 back. So the true cost is really only $3,250 for Marion. So even though they donated the same amount, Marion gets more money back from her taxes because she's in a higher tax bracket, which is why people in the higher brackets are usually that, and they have the money to donate. Usually the higher bracket people are the people that are donating more money. And the truth is, Drew probably isn't going to benefit from that 15% at all, because if you're in the 15% tax bracket, you're probably going to just take the standard deduction. But if not, this is what their true costs would be. Okay, so you've got homework. What are we on? 4E. It's kind of the last one of this section, and then we're going to move on to statistics. Woohoo. So work on 4E at home if you would like. We will work on it in class. You can ask questions. I will work with you through those problems if you get stuck. So we'll see you in class.